studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
In this slide, we examine a planning strategy that often attracts significant attention from tax professionals and the CRA alike, using salaries to reduce investment income inside a corporation. At first glance, the idea appears straightforward. A corporation earns investment income from sources such as dividends, interest, rental properties, or capital gains. The corporation then pays a salary, creating a deductible expense that reduces net investment income and, potentially, reduces corporate tax. The flow shown in the center of the slide illustrates this concept. Investment income flows into the corporation. The corporation pays a salary expense. That salary reduces net investment income, which may ultimately reduce the corporation's tax burden. Because of this potential tax benefit, many corporations consider using salaries as part of their overall compensation and tax planning strategy. As shown on the left side of the slide, there are several possible advantages. A salary deduction may reduce investment income, lower corporate tax, facilitate cash extraction from the corporation, and support broader compensation planning objectives. However, this is where the caution begins. Unlike investment advisory fees, portfolio management fees, or interest on investment loans, salary deductions are subject to much greater scrutiny. The CRA does not simply ask whether a salary was paid. The CRA wants to understand why it was paid. On the right side of the slide, you'll see some of the key questions that CRA auditors often ask. Was actual work performed? Was the salary reasonable for the services provided? Can the work and compensation be properly documented? And perhaps most importantly, was this truly compensation for services, or was it primarily a tax-motivated arrangement? These questions become especially important when salaries are paid to shareholder managers, family members, or individuals whose roles are not clearly defined. A salary deduction is generally strongest when it reflects genuine work that provides real value to the corporation. The more the payment resembles ordinary commercial compensation, the easier it is to defend. The key concept at the bottom of the slide summarizes the entire lesson. Unlike investment advisory fees, salary deductions require much stronger support and justification. As tax professionals, we should never assume that a salary deduction will automatically be accepted simply because a payment was made. Instead, we must be prepared to demonstrate the services performed, justify the amount paid, and maintain documentation that supports the deduction. In other words, reducing investment income with salaries may create a tax benefit, but it also introduces additional CRA risk. And that is why salary-based planning requires a much higher level of care, documentation, and professional judgment than ordinary investment expense deductions. In this slide, we take a closer look at the questions the CRA may ask when a corporation claims salary deductions that reduce investment income. The key lesson is that paying a salary is not enough. The corporation must be able to demonstrate that the salary represents genuine compensation for actual work performed. At the center of the slide, you'll see the CRA review checklist. This checklist reflects the types of questions an auditor may ask during a review. The first question is straightforward. Did the individual actually perform work for the corporation? A salary deduction is much easier to defend when the individual actively contributes to the corporation's operations, investment management activities, administration, research, or decision-making processes. The second question focuses on duties. What specific tasks were performed? The CRA often wants to understand exactly what services were provided in exchange for the compensation. The third question concerns time. How much time was spent performing those duties? The more significant the role, the easier it becomes to justify a meaningful level of compensation. The fourth question examines reasonableness. Even when real work has been performed, the salary must still be reasonable relative to the services provided. Compensation that appears excessive compared to the actual duties may attract additional scrutiny. Finally, the CRA may ask whether the work can be proven. This is where documentation becomes critical. On the left side of the slide, you'll see examples of strong supporting evidence. Employment agreements, timesheets, meeting records, investment analysis, and management reports all help demonstrate that meaningful work was performed and that the salary has a legitimate business purpose. These records create a clear connection between the compensation paid and the services received. On the right side, you'll see examples of weak support. Situations where there are no records, no documented duties, no evidence of work, or where the salary appears to exist solely for tax savings purposes create significant risk. In these cases, the CRA may question whether the payment was truly compensation at all. Notice the key message in the upper right corner of the slide. A salary should be compensation for services performed, not simply a deduction created for tax purposes. This principle is at the heart of every salary deduction review. The more a payment resembles genuine compensation, the stronger the deduction becomes. The more it appears to be driven solely by tax reduction objectives, the greater the audit risk. The important principle at the bottom of the slide summarizes everything. The stronger the evidence of work, the stronger the salary deduction. As tax professionals, we should always approach salary planning with documentation in mind. Before focusing on the tax benefit, ask yourself whether the corporation could clearly demonstrate who performed the work, what was done, how much time was spent, and why the compensation was reasonable. When those questions can be answered confidently, the salary deduction becomes much more defensible if the CRA ever comes knocking. In this slide, we bring together everything we've learned about salary deductions and focus on one critical question. Is the salary genuinely compensating someone for work performed? Or is it primarily being used as a tax reduction tool? The answer to that question often determines whether a salary deduction is accepted or challenged. Let's begin with the left side of the slide. This represents a reasonable salary arrangement. The individual performs actual duties for the corporation. They regularly contribute to the business or investment activities. Their work is documented. The compensation is reasonable for the services provided, and the arrangement would make sense in a normal commercial setting. Because the salary reflects genuine work and genuine compensation, it is generally much easier to defend if the CRA reviews the file. Notice the green shield at the bottom. The result is a more defensible deduction and a lower risk of CRA challenge. Now let's compare that to the right side of the slide. This illustrates a risky salary arrangement. Here, the corporation pays a salary, but there is little or no evidence supporting the payment. There may be no documented duties, no timesheets, no records of work performed, and the compensation may appear excessive relative to any services provided. In some situations, the arrangement may appear to be driven primarily by tax savings rather than legitimate compensation. When that happens, the risk of CRA scrutiny increases significantly. The CRA may question the deduction, reassess the corporation, and potentially impose additional taxes, interest, or penalties. The balancing scale in the center captures the key concept. On one side is real work. On the other side is tax motivation. The more a salary resembles true compensation for actual services, the easier it becomes to justify and defend. The more it appears to exist solely for tax planning purposes, the greater the audit risk. At the bottom of the slide, you'll see a practical decision-making framework that tax planners can use. First, determine whether a salary was paid. Next, ask whether meaningful services were actually performed. Then evaluate whether the compensation amount is reasonable. After that, confirm that sufficient documentation exists. Only when all of those conditions are met does the salary become potentially defensible. The tax planner's pro tip at the bottom summarizes the entire section perfectly. Reducing investment income with salaries may be possible, but salary deductions receive far more scrutiny than ordinary investment expenses. For that reason, every salary deduction should be supported by 3 things. First, clear evidence that real work was performed. Second, a reasonable level of compensation. And third, strong documentation that can support the deduction if the CRA asks questions in the future. The ultimate goal is not simply to reduce tax. The goal is to create a salary arrangement that remains reasonable, supportable, and defensible long after the tax return has been filed. That is what separates effective tax planning from risky tax planning.